In the world of finance, speed is everything. And right now, the National Stock Exchange of India is getting ready for a massive upgrade. We're talking about processing trades at nanosecond speeds. Now, this isn't just about making things faster. It's a technological leap so huge that it actually forces us to ask a really fundamental question about the very design of our markets. So let's just get our heads around what a nanosecond even is. It's 1/billionth of a second. It's a timescale that's, almost impossible for us to truly comprehend. And yet, this is the new reality, the new standard for how trades are going to be executed. Okay, check out this analogy because it really helps put it in perspective. Imagine if one tiny nanosecond was stretched out to feel like 1 second. Well, at that scale, just a single second of our normal time would feel like more than 31 years. That is the insane level of time compression we're dealing with in modern trading. And that, right there, brings us to the core question of this whole discussion. When our technology can execute trades at these mind-boggling speeds, do our old structures, like a 6-plus-hour continuous trading day, even make sense anymore? It's kind of like we've built a Formula One engine, but we're still driving it on city streets.
So here's how we're going to tackle this. First, we'll dig into the nanosecond scale. Then we'll look at the history of trading hours. After that, we'll contrast speed versus duration, lay out specific one-hour proposal, and finally wrap up by talking about the bigger idea of aligning market design with our technology.
All right, first up, the nanosecond scale. It's really important to understand that moving to this kind of processing isn't just a simple upgrade, it's a total paradigm shift. It fundamentally changes the relationship between time and transactions in the market. And look, the technical benefits are undeniable. The exchange can handle a way higher volume of orders, it can match buyers and sellers with incredible efficiency, and it can stay stable even when the market gets really volatile. From an infrastructure standpoint, it's a huge win. But here's the real takeaway. Technology like this doesn't just speed things up, it literally compresses time. And whenever you have that kind of dramatic compression, you absolutely have to go back and re-examine the old assumptions that our systems were originally built on. So how does this incredible new speed connect with the simple length of the trading day? Well, to figure out where we should be going, it helps to first take a quick look at how we even got here in the first place. The current trading hours haven't been around forever. The Indian markets used to open at 10 a.m. The move to the current 9:15 a.m. open just goes to show that these hours aren't set in stone. They can, and they have, changed over time. Now, one of the main arguments you hear for longer hours is about aligning with global markets. But the truth is, with time zones spread all over the planet, perfect synchronization is just mathematically impossible. When India opens, Tokyo is already deep into its day, and New York is still fast asleep. The best we can really do is get a small overlap with European markets. Okay, this brings us to the analytical heart of the matter, the key difference between speed of execution and the duration of the market, right? Just because your engine can run incredibly fast doesn't automatically mean you need to run it all day long. The best way to think about market activity, or what we call liquidity, is to compare it to rush hour traffic. It's not this steady, even flow all day. Instead, you get these big surges at specific times, usually right at the beginning and right at the end of the day. And you can see that pattern clearly here. Trading intensity spikes right at the open, then it has a real lull during the middle of the day, and then it picks back up again as we head towards the close. That midday period is often surprisingly calm. So that raises a really important question. Does keeping the market open longer actually make it better? Or does it just take all that focused activity from the open and close and stretch it out over a longer day, potentially making the market thinner at any given moment? So what's a potential solution being floated? It's really important to frame this correctly. This is not some call for a radical disruptive overhaul. It's being presented as a modest recalibration. The idea on the table is incredibly simple. Just go back to the 10 a.m. opening time. That's it. It's a 1-hour adjustment, returning to a structure that, by the way, the market has successfully used before. So what would actually happen? Well, with nanosecond tech, the market could still easily handle all the transactions. Big institutions could adjust their algorithms, no problem. Retail investors would still have a massive window to trade. And all the important plumbing, settling trades, pricing derivatives, none of that would change. The foundation of the market would be just as solid. And this all leads us to the bigger picture. This whole conversation is really about one thing: making sure that our market's design is keeping pace with its incredible technological capabilities. It's about smart design, not just about raw power. Now, of course, there are trade-offs to consider, and it's important to be balanced. A shorter day could mean more volatility right at the open, but the counterpoint is that activity already clusters there naturally. You might have less global overlap, but we've already seen that overlap is pretty limited anyway. And yes, people's routines would have to change, but the core argument is that market structure has to be willing to evolve.
This quote really captures the whole philosophy perfectly. This discussion isn't about being anti-technology or resisting innovation. It's actually the opposite. It's about thoughtfully aligning our market's rules and structure with the incredible new tools that technology has put in our hands.
So we'll end with this final thought. Technology has sped up time in ways we couldn't have even imagined a few decades ago. So as our infrastructure gets smarter and faster, shouldn't our schedules evolve too? The question isn't whether the exchange can run for over 6 hours. Of course it can. The real question is, in this new age of nanosecond trading, should it? Or has all this new tech quietly made one of those hours completely redundant?